great thing about the course is that as you learn things, you can actually apply them immediately. And as you go through, you might say to yourself, hey, as I go through the course, I would like to try some ideas without risking any money. Can I do that? And you most certainly can. And that's where paper trading and backtesting comes in. They're really, really helpful. So let's talk about that for a moment. So paper trading is where you'd use like an online broker or a research site or something for free with fake money, right? So it's for free and you're not using your own real money, you're using fake money, and where you can actually apply what you're learning in this kind of this free, safe environment. It's a safe space where you can learn the mechanics of placing trades and building your portfolio, and you can also test drive out and try out some of these new investment indicators or tools that we're going to learn about, strategies and order types, all these things we're going to learn about without risking any real money. Now, not everybody offers paper trading, but but many do, and I'll show you some examples, later in the course too, where we'll use at the end where we do some demonstrations where I'll be using paper trading, so you can see some examples of places that do, and also how to find them. But that's the great part of paper trading to take away for now, is that you can actually practice for free with fake money. And so you can kind of see, and with real stuff. This is with real cryptocurrencies and all that too. This is like real time as far as in the real market. So you can really see what would have really happened if you had invested real money. Oh, and off the bat, a couple places for cryptocurrencies, because they're not as prevalent as, let's say, like the stocks would be, stock market, for paper trading. But TradingView has a free paper trading thing. You can, with ads, you can do stuff for free there. And then eToro, which is kind of like Robinhood, kind of like a low-cost broker thing. They have some free paper trading as well too that you can do as well if you sign up with them. And eToro's in a lot of different countries and support a lot of different areas, just like TradingView uses a lot of different countries. So, and you can see here from eToro, you get $100,000 to practice and improve your trading skills. I would assume that if you're from, let's say, India, that would be, on their India version of the site, it would say rupees or pounds for the United Kingdom or euros or whatever might be your currency. But it's the idea that you can practice and trade for free. Now, backtesting is a little different. So that's the same thing where you're using an online broker site for free and you're using fake money, but the idea is that you're going to kind of backtest or test some of your strategies or ideas going back in time. So if paper trading is like forward in time, I'm practicing in real time right now, backtesting would be going backwards in time and seeing how things would have played out. And it's an idea of trying out a strategy or use of a technical analysis tool or tools, and you want to see what the results would have been in the past. Would it have succeeded? And the key is that it's really using real data pulled from the broker site automatically to kind of run this backtesting. Now, backtesting can get a little trickier, and that's also even less offered than paper trading. So if you don't find some backtesting things, there's no worries. Most people, love the paper trading part anyways. But the idea is there is ways that you can backtest your stuff as well, and you can search for those types of things as well. So paper trading and backtesting, they're very similar, and the whole goal with both of them is they're designed to practice what you learn in the course. Think again, backtest is more like historical information that you're using, and paper trading is practicing with current information, and then going forward. So you'd see how it might play out over the next hours or days, depending on what your time frame is. And both of them are using, in effect, live trading, is the idea of live trading, but with fake money, not real money. And then eventually you graduate up to you live trading yourself, maybe starting with small amounts of actual real money. And so you might ask also, why would places offer free accounts to start where you could just kind of practice? And there's a lot of computing power behind that to make that happen. And the idea is that online brokers want you to be successful. They want you to learn and use their system, especially learn their system and love their system, their platform. And then they want you to eventually trade real money, right? So they can charge fees against it. That's how they make money. They don't make any money on free practice testing stuff or paper trading, but they make money after you become confident. And when you start putting in your real money, that's where they make their money. So they have really nice, good paper trading systems and backtesting systems in many cases as well. So paper trading and backtesting, great way to start. Oh, and when you are ready for, let's say, more actual live trading, a good way is to I have a whole section on exchanges, so watch that section. But you can also kind of start early just looking for paper trading stuff. You can Google things just to search like cryptocurrency exchanges that are in your country. That's the key first thing you want to look at, is what's supported in your country, because not everything is. So this is cryptocurrency exchanges in the UK, for example, or cryptocurrency brokers in Canada, or India or wherever, United States, put in whatever, your country is. You want to narrow that field down before you start looking at, let's say, an exchange real closely or a broker closely, and then find out, oh, they don't support my country, because these are all regulated. So, you have to kind of understand that as well, too. We're going to have some other examples of where you can find some of these things also by country or different ways you can find stuff in the exchange section. But here's a nice little link or a nice place to get you started if you're curious, called BitcoinTradingSites.net. And they have different ways that you can kind of evaluate or look at different ways to trade. And they have a nice part where you can kind of get a download by country. And you can see the example here on the screen. And so that's really nice, where you can start narrowing your choices down, because, and make it easier for you to find the exchange or the broker that you want to use. So watch through the next lessons as we talk about cryptocurrency coins, especially that section of exchanges. They'll kind of help set you up for success too. But then the real, meat of the whole course is in the trading indicators section and how to place orders and strategies that come later too. But this is kind of like the building block stuff to get you there. I know you're probably eager to really apply a concept or do an activity right away so we can start seeing how these indicators and things with technical analysis work. And so I'm going to show you one right away, one of the big indicators. Then we'll get into the overall concepts of technical analysis and a little bit about cryptocurrency in general, from the coins themselves to the exchanges and how to pick exchanges. But I want to give you something where you could say, oh, look, this is not too hard. This can make sense to me, and maybe something you could apply even right away. So we're going to do that, and in this we're going to talk about one of the indicators, one of the most popular indicators out there, which is the moving average crossover indicator. And basically what it is you have a moving average, right? That's looking back in time, looking at your average prices over time. And as you see from the image here, you have this orange line kind of going through these different prices. These are candlestick prices. Each are, you could say, could be a daily price in there as far as looking at these different daily prices. And the moving average is going through those. And when the daily price, or could be hourly or minutes, depending if you're like a day trader or whatever, and I'm going to show you how to look this up as far as how to actually apply this, and you can do it yourself. But the big concept here is that when the price goes above the moving average, when it first crosses over that moving average line, that is a buy signal. And you can see in the green where we've highlighted with some arrows where it's crossed over, and that's now a buy signal. When it crosses below the line, when it first crosses below, that's a sell signal. And the reason for this, it may seem counterintuitive a little bit, but the reason for this is we're looking at trends. What is the direction things are headed? So if we look at that first buy signal, you can see we would have bought, right when it first crossed that moving average line, and then we had a period where it went up in price. This is good because this is where we're making profits. Then it went sideways a little bit, and then we could sell then later when it goes below the price. Where you see a lot of above and belows, that's called whipsaws, and it can give you a lot of false signals. And in the lessons around moving average, which we get into simple moving average, weighted moving average, exponential moving average, all sorts of deep concepts, including these whipsaws, will help you understand and how to evaluate that and how to avoid a lot of extra buying and selling unnecessarily. But right now, I want you to just grasp the concept. If it goes above the line, it's a buy signal. And if it goes below the line, it's a sell signal. All right, so in the real world, let's look at a site in terms of how can we actually look this up using our cryptocurrencies. Okay, I'm at a site called TradingView. You can find it here at tradingview.com. TradingView is a real powerful site. You can use it for different types of markets, from cryptocurrencies to stocks to futures, all sorts of different things, as far as what TradingView can do. And let's say you want to look up the price of something and apply our moving average. So I'm just going to show you a little bit of this. And then later in the course, we have a whole demonstration using TradingView because it's free with ads, or there's a pay version too. But it's something that anybody can get at as far as using something to apply some of the concepts. So we go into TradingView, and let's say I'm interested in this currency called EOS, right? Now I could type in any type of cryptocurrency. Let's say I want to type in Bitcoin. Show me all these different pairs with Bitcoin, right? With dollars, or Cardano or Polkadot, Litecoin, XRP, all sorts of different types of cryptocurrencies. But let's say I want to trade EOS, which is another type of cryptocurrency, and I want to trade it with like euros, right? So maybe I live in the European Union and I want to trade for euros. So I type in EOS. The first thing is the thing I'm buying, or the first pricing of the pair, and then this is what I'm buying it with. So here's an example of EOS to USD would be how much US dollars is it taking to buy one EOS coin, for example. And I can trade cryptocurrency for cryptocurrency. Here's EOS for Bitcoin, for example. How much Bitcoin would take to buy, buy EOS, and Ethereum, and all sorts of different ones. But let's say here we have our euro, and we're going to look at that. So I'm going to click on, for just our demonstration. So here's EOS for the euro. I clicked on that. You can see it's EOS to the euro, and it looks like we're right now trading at 3.1784 euros would buy you an EOS coin. Looks like we're up a little bit for the day. So you can see this is the information. There's lots of information on this page, but we want to go to full featured chart here. Again, very powerful thing. There's lots of good websites out there that'll tell you how to trade on TradingView, tutorials and things, which you might do at some point. Or else a lot of this you can do on an exchange that you'll end up picking anyways too, where you can do these same kind of concept, these charts and stuff. And we're going to learn all about charts, so don't worry about that as well either. We're just going to look at that moving average as an early indicator. So what we see here is EOS for euros, the sell price, the buy price. This is a daily chart, so it's this day here. If I click on it, I could change it to minutes or hours. So if I was a more frequent trader, again, like a day trader who's trying to close all their positions within a day, I wouldn't be looking at a day or a week or a month. I'd be looking at like at hours. I can also change the look of the chart. This is a candlestick chart. We're going to learn all about candlestick charts. You'll be an expert by the end of that section. It's a great section. But for now, all you need to know is this is the range of prices, both the body of the candle and then also the wicks at the top and the bottom. Some have narrow bodies and very long wicks, as you can see. But this is the range of prices. And in this one, if it's like green or some places that would be black, you would be, the end of the day would be up. So it's an up day. So here we'd see 1, 2, 3 days in a row that were up. And then red would be a close down for the day. So one little close down day and then back up again. And you can see we kind of go sideways here again as well. So this is, basically, just some stuff around reading a candlestick chart. You can change this by clicking on here, the little image here, to like, let's say different types of charts. We'll learn about those too. Sometimes a line chart makes it easier to see, just an overall, open close as far as the closing prices of the line. And it's easier to see where maybe that crosses over in terms of a moving average when we put the moving average on there. But let's put it back to a candlestick chart for now. So now let's say we want to look at that moving average, and you'll see it under formula. This little formula symbol here. It says indicators and strategies. This is where you'll go for a lot of the different indicators that we're going to learn about, like relative strength index or the different types of moving averages. But I'm going to click on this, and I'm going to scroll down. I'm going to be under built-ins is where I want to be. And I'll scroll down, it's all alphabetical, and I want to look for moving average. Here we go. So I've got moving average, which is a simple, basic moving average, exponential, and weighted. We'll learn all about these. But right now we're just going to practice with moving average to show how you can easily look at an indicator right away. So I'm going to click on moving average. We'll close out this. And now you can see our line going through our prices, right? You can see where it's gone up, where it's been above the line. I'm just scrolling my mouse, by the way, to make this go back in time. Towards the bottom here, you can kind of click these buttons here, left and right, to go forward and backward, or faster, you can kind of click like this with your plus minuses. So you can see where we've had this long period where it's been above the line, and when it goes below the line, certainly fully below the line, even a little bit, that's like a sell signal. This is that whipsaw part we were talking about, where it's above and below the line a lot. But here, where we're fully below the line, that's definitely would be a sell signal in there, as far as that would go. And you can see, well, it's kind of turned out to be that way, right? Look how the prices kept going down after we had that strong sell signal. Now, if we look at this, where it looks like we're crossing above the line, so we would have to see what the future would hold in terms of price. This, the vertically, the higher price is up going this way. You can see the price for euros here, currently at about 3.17. And then left to right is time going, back in time. And again, you can change your time frame. So this is that simple concept of it goes below the line, sell, goes above the line, that's a buy signal. This happens to be a 9-day moving average. That's the default over here in TradingView. You can see where it says MA9. You can actually change that. So this is getting a little bit extra stuff here for you, but I just go into settings. and I can change that length of time from a 9. Let's say I want to go to a longer time frame. I could go a shorter time frame too, but let's say I want to look at something over a long period of time. Let's say I want to look at a 90-day moving average, or basically 3 months. How's the moving average looking? So something much more established as far as that would go. And then let's say style, I can change that. I'm going to change this to be kind of orange in color, and just so we can see that a little better. And I'm going to put it, kind of a dark, a bigger line so we can see it. So as you can see, short term, it was saying we had sold up here, but over the long term, over a 90-day moving average, you can see this is still well above the moving average over a long period of time, 90 days. Again, the moving average section, we're going to learn all about this, but the easy thing is if it's above the line or crosses above the line, that's a buy signal. And when it crosses below the line, that's a sell signal, because that's what trends are establishing. You're going to follow the trend. So we go back in time here. So some real interesting stuff here, right? So we see a lot of approaching the line here, a lot of whipsaws a little bit here. But once we get established right here, actually right here, you can see we have our first crossover. We have a short period where if we would have bought in here, we would have made some profit, gone down, and then we would have sold. And we may have sold before that, or we might have sold right about the same time and maybe not made as much profit. We'll talk about entry and exit points. Don't worry, that's coming. But also here, where we've got this uptrend, look at that, 3 days in a row, crosses above the moving average, a long moving average line of 90 days. And now we've got 2 more up days, a little sideways, but then a definite big trend up. So if we would have bought in here, we would have definitely had this big trend up. But with a 90-day moving average, it's not as sensitive. So you can see we went up, but then we've come down and we've given back a lot of those profits. So that's why maybe if you were looking to trade more frequently, you might have something be more like a 14-day moving average instead of, let's say, the 9-day. That's like 14 days, like 2 weeks or approximately. Actually, 3 weeks in terms of trading days. Well, actually, with cryptocurrency, it's 14 days because it's always open. And if I change that to 14 days, again, you can still see the same patterns doesn't change, just the price doesn't change. What I'm changing is my moving average to see, more sensitivity. And here I go above, long type of uptrend. But see, when I change to a moving average, how once it crossed below here, this was that strong sell signal, I would have got out right here and I would have made more profit. Let's say I bought in here and I would have rode this all up. I might have stayed in here, but once it really went down, I would have sold to make all this profit in here as opposed to coming more further down. So different ways of looking at these, and this is just one indicator. There's many other indicators. We're going to look at a whole bunch of them that you can do. Last thought here on TradingView 2 is there's so many different things, and it can get real confusing. There's all sorts of things on the side here you can put on here, trend lines, all sorts of stuff. I'm going to give some big demonstrations at the end of the course, where we kind of pull all this information together with a lot of different indicators. So, but if you really are excited and it's like, oh, I want to start trying this TradingView, 2 things. It's free, but with a lot of annoying pop-up ads. And 2, watch a tutorial somewhere on the internet as far as how to use all these different things. I've showed you just a few. Just learn TradingView before you really get really into it. So with that, that's a simple way of looking at an indicator. Now let's talk about some general concepts about why technical analysis works. We'll talk about cryptocurrency coins. We'll talk about exchanges and where we trade these coins. And then most importantly, we're going to get into a massive, many hour section on how to learn about these different indicators like the moving average and many other ones, and then also how to apply those and how to apply a strategy around those and how to apply entry and exit points, when we buy, when we sell, and how to apply all this so we can be successful and profitable traders in cryptocurrency. In this lesson, let's learn how to really read in detail how to read a cryptocurrency chart. It's going to be one of the foundations of how we're going to evaluate different cryptocurrencies and decide whether we want to buy or sell or different parts of trading. And for many of you, you might look at this and this will be kind of a quick review or pretty easy. And for some of you, it might be like, I'm already confused. This looks weird. Don't worry. We're going to walk right through it. You'll be an expert in this and you'll see several of these as we go through the course, and it'll be very second nature to you. So no worries. We'll walk right through this, each part of it, in a very simple and easy manner. So as you can see, I've got some different numbers on the chart, and that's going to help guide us as far as what we're going to talk about each of these different sections and what they mean. So if we start with number 1 there in the upper left corner, that's the trading pair. With cryptocurrency, they trade in pairs. You're trading like Bitcoin for US dollars or Ethereum for another coin, something like that. In this example, we happen to have XRP, which is Ripple, a cryptocurrency, being traded for euros in this particular case. So it's XRP for euros. So this is basically, I'm using euros to buy XRP or Ripple cryptocurrency. And also you could have it be cryptocurrency for other cryptocurrencies. So this could be XRP and it could say BTC for Bitcoin or ETH for Ether or Ethereum. I could use, cryptocurrency to cryptocurrency or cryptocurrency to fiat or regular kind of money currency and back and forth, right? So I could also trade euros for XRPs and just switch them, and it would just change a little bit on our price part on number 2 there coming up in a second. So this is we're basically buying Ripple with euros. And then everybody's chart system looks a little different, but somewhere you'll see where it's the time frame. This says 1D. So each of our price bars we'll talk about in a moment is a daily price chart or a daily price bar. This could be minutes, it could be hours, it could be weeks, it could be months. You have the ability to switch that depending on what type of trader you are. If you're a day trader, you're going to look at like minutes and hours versus somebody who's like looking at something very long term. I look at days and weeks, for example. A real side note here below where it says MA9, all that stuff below. That's an indicator that we've overlaid on the top. That's number 5. We're going to talk about in a second for a moving average. So basically, somewhere in your chart, you're going to see what you're trading and what's the time frame on it. Oh, and the nice thing too, with technical analysis, is that you can use the same concepts, the same types of charts, all this, no matter what time frame. So you don't have to worry about, do I have to learn certain concepts for certain time frames? No, you don't. Not with technical analysis. So number 2, over there on the far right side, that's our price. And you can see that's in EURs or euros. And so this is what we pay in euros to buy one XRP cryptocurrency. So that's just our price on the vertical axis, higher price up to the top, lower price towards the bottom. And that's the range of prices there. Number 3 there along the bottom is the time frame in terms of length of time over, in this case, it would be days. You can see 5th day of the month, 11th day of the month, and then a new month starts and all that, and it keeps going. Again, that'll change depending on what you choose to set up for your time frame. But the horizontal axis is basically time, and you're going back in time from left to right. So the most current prices and the most current offering is to the right of your timeline there, where you start seeing price bars. Number 4 is the actual pricing itself. In this case, there's a very common way of looking at it in terms of what's called a candlestick price. You have different types of price bars out there. We're going to learn all about them. It could be like prices represented as just a smooth line. They could have different shapes to that. It could be dots. It could be a lot of things. But candlestick is probably the most commonly used and very powerful. We have a whole section on candlesticks. So don't worry about trying to interpret this now. We're going to walk through that upcoming in the course. But for now, all you need to know is that on your price chart, each of those individual candlesticks are individual prices for that particular day. And if you look at by the number 4 there, we've got it, it looks like a candlestick, right? You've got a body of a candle, that green one there, a big long green candle there, our price, and it's got a little wick at the top, or some wicks are longer than others, and that's kind of showing the range of prices that happened on that day. And the colors tell you whether the day closed down or up. And you can probably guess that an up day might be, in this case, would be green, because a down day would be red. And you probably see that one that to the right of the big tall green candlestick, you've got a really tall wick on that red candlestick, and that means something, and we'll be talking about that too, but basically a wide range of prices, but closed down. So that's your prices represented as bars, but again, they can be represented different ways. The main thing, that's going to be the main part of the chart where you're looking at the actual prices and the range of prices. Number 5 represents different things that you can then overlay on top of your chart. You don't have to do that, but there are different things we're going to learn as far as indicators and tools we're going to learn that we might be overlaying on top of the chart, and we're going to interpret based on that. This particular one here, that line, you see that line, that smooth line that's kind of going between the candles, and some are above, some of the candles are above, some are below. That happens to be a 9-day moving average line. That's on the upper left where I said MA9, that was going to mean something. Well, this is what this means. It means we've chosen a 9-day moving average. And the whole section on moving averages is really powerful as far as using it for an indicator, whether something is above the line or below the line means something, or right on the line, all that means something. What you want to take from now is that on your chart, you can lay things across it, and that you can then interpret things from that. If we were to change, let's say, that moving average from a 9-day moving average to, let's say, a 20-day or a 200-day moving average, then the line would move and it would be represented differently on the chart. Number 6, I just put a couple there as representation, but a lot of times you'll see it run along the whole bottom of the chart are these vertical bars. They're not actual price bars, they're not candlesticks. They're just these different types of up and down bars, and some are taller than others. And that would represent volume or trading volume. All that means is how many transactions are happening, how many buy and sell transactions are occurring. And as you can see, some days we'll have more transactions than others. And again, that can be an indicator for us too. So we have that long price bar, number 4 there. It had also a big trading volume day in comparison to 2 days before it. That might mean something to us, and actually it does. It means it's a very strong price trend, or something happening is very strong with the price there. So number 6, it would run typically, I just made it simple here, but it would run along the whole length of every price bar would have a corresponding horizontal bar below it as far as volume. In a lot of software and a lot of platforms, you can turn that on or off. But if you see things running along the bottom, that's the volume and the number of transactions. And then lastly, you can have indicators that go above or below your chart. Depending on your platform, you can kind of choose where you want that to go. You can see here at number 7, we've added an indicator which is called a relative strength index, or RSI. Again, whole section on that, whole lessons on that, a real good indicator. But it's basically something I've overlaid or underlaid, in this case, the underneath the chart. And from that, I can interpret in there's meaning to, let's say, an RSI indicator. And again, that's going to come up. To give you a quick little preview, you can see where it's kind of highlighted there between the number 70 and 30. That's not prices, by the way, that's percentage. And it's looking at momentum and different things. But the real quick way, you're going to have a whole lesson on this, but if it's above 70, that means it's like an overbought situation. And if it's below 30, that means it's an oversold situation. So we might want to be selling. If we're above 70, it's indicating that prices might drop. And if it's below 30, that means we might have an opportunity for rising prices. And actually in this chart, it's just a little preview, you can kind of see where it got above 70 and where it peaked right on that day, right before that big red candle, where it went down in price. Again, the prices are going down, even though it had a high range to the top. Where it closed was at the bottom of that candle, and so closed lower than the open and closed lower than the day before. So this was an indicator that worked, that told us, what might be coming. So there you have it. Just basic ways to read a chart. Pretty simple. You'll be practicing with it, and you'll see lots of examples through the course on it. So review this lesson if you need to, but otherwise, you're now an expert on reading charts, and you'll be completely reinforced as we go through the course and through the individual lessons, and certainly with all those individual indicators to help us make good buying and selling decisions. Let's talk about why technical analysis works, and it works very, very well most of the time, but not every time. And so we'll get into that a little bit and kind of the underlying concepts around technical analysis when you're looking at a security. And a lot of it gets back to that whole idea of supply and demand, right? It's if you have a lot of demand for something, the prices will rise up. If somebody really wants, a whole bunch of people are buying a certain product, for example, the person who sells that product could raise the price. Same thing with trading of a security. If there's a lot of demand for a security, the price will rise. And so what this leads with the supply and demand, it leads to predictable behaviors. If we start seeing certain patterns or certain things happening, we can anticipate that there's going to be changes or things that are going to happen that are as a result of that supply and demand. And it's been around a long time. I mean, it's been around since like the first time it was ever talked about in the book I read was in 1948. So it's not something that's like just brand new that's never been really proven or tested. It's been used for a very long time. In fact, some things like candlestick price patterns and all that have gone way back, hundreds and hundreds of years back in Japan. But certainly the term technical analysis, certainly since 1948, and many different things around that and proving why that works. But not all the time. So let's talk about what's the idea behind this. And one way to think about it is how people will travel together, or people will invest together, or traders will get an idea and they'll kind of start moving together, right? And that's kind of what we think about as trends, right? Think we're all kind of moving in the same direction. It's almost like a herd mentality, right? Okay, so I'm not going to say that people are like sheep. Okay, people are not sheep. Okay, but it's the idea of a number of people or animals traveling together, going in the same direction. So like if you look at this picture, for example, you could see that the sheep are traveling in a certain direction, right? They're headed downhill on a road, and it's nice and easy for them to walk down the road, and they're all kind of headed in that same direction for the most part. You can even consider that momentum investing, right? And we'll talk about momentum indicators, where they're all kind of headed in this easy trend going down the road. But you might also notice something that's going on that's a little different in the upper left. Do you see the little grass there on the left? There's a few sheep who went on the grass that, hey, this looks pretty good over here. Let's go over here and have some grass. Now, they're not following the trend. Like if we were investors, we might say that this is a definite downward trend, right? Look at how everything's kind of moving down the hill, and it's easy to move down the hill. But we'd want to watch what's going on in that hill over there, because that might be what we would call in technical analysis a breakout or a changing of the trend. And is it going to be a real breakout? Is it going to change the trend? Are the sheep going to change their direction and now go to the hill? So if we think of this as terms of a security, let's say prices have been falling, going down the hill, but now something's happening, something in the news or people are just for whatever reason are changing that supply and demand, and they're going to now go on the hill and the prices are going to start to rise. So if we have an indicator that says, when certain things happen, people are going to start changing, the prices are going to start rising, kind of the idea of just like we see enough sheep that go up on the hill, the sheep will change direction too. So maybe it's a breakout, maybe a trend is forming, maybe it's just a retracement, which is another term for just a temporary move where it kind of goes up for a little bit and then comes back right away. It's a temporary move. So we're going to learn all about that. So that's the underlying idea of why it works, because it's looking at these big kind of macro type trends. Now it doesn't work every time because one, nothing's 100% perfect, of course. And then there's unexpected random events that can occur. But there are things that can happen at real big country or global levels too that are really beyond our control and even beyond our analysis because something really unexpected happened. Technical analysis is about buying at the right time, but also selling at the right time and avoiding big losses like that. And if you're, like, say, a buy and hold investor, which is different than trading and certainly different than technical trading, you can suffer through that, and then you just don't get out. You don't get out soon. You try to ride out the storm. So another thing with technical analysis, too, is it doesn't tell you how much to invest. It tells you with indicators and things whether you should invest and how, but it doesn't tell you how much. We'll talk a little bit about some money investment strategies at the very end of the course, too, to help you with that. But the actual indicators and things don't tell you, like, if I see this price bar or I see this moving average go like this, I should invest X number of whatever of my money. It doesn't tell you that. It just tells you what's happening, and then you decide what action you want to take on that. So technical analysis is terrific, been around a long time, works, but not perfect. Nothing's perfect, right? With investing and trading, there are two real big schools of thought, and that is fundamental investing and trading, or fundamental real investing, and technical analysis. And this, of course, is all about technical analysis. But let's talk a little bit about fundamentals and how you can maybe apply some fundamental concepts of that school of thought to cryptocurrency. And I'll also actually tell you why cryptocurrency of many different types of securities out there really lends itself even better to technical analysis. So if we look at fundamental analysis, that's understanding the fundamentals of something, like understanding the underlying business model of something, like a company example, or even a coin. What is the underlying business model behind it? How does it differentiate itself? How is it different than, let's say, its competitors? And what might be the product or service it might offer? What are some of the features or benefits? Or like in a cryptocurrency coin, the project and stuff, what are some things it might offer in terms of a feature of that coin or underlying blockchain technology that might be different than other ones? And is there a first mover advantage, right? Is there some coins that got in earlier and so they have an advantage because they were just in there earlier than others? And then what are the barriers to entry from new competitors coming in or copying them and maybe outdoing them? So these are all kind of fundamental things, and certainly from things, are they in it for the long term? Are they more of a short-term ICO, initial coin offering that just doesn't work out, or it just really never takes off, or is it something that's more established that's really going to have some staying power? So you can see from fundamentals, we're not talking about charts or anything like that. We're talking about more conceptually, what are some competitive advantages and what's conceptually going on here and how to evaluate a business or a concept. So let's apply that, let's say, to some cryptocurrency to really understand how we could maybe use or how we could use fundamental investing with a cryptocurrency. So for example, let's say we take Bitcoin, for example. Well, certainly in terms of a brand name, it is by far the dominant brand name in cryptocurrency. I mean, a lot of people that might say, oh, I know Ethereum, I know Ripple, I know other ones, but for the general public out there, they know Bitcoin. If they know anything about cryptocurrency, they know Bitcoin. So it's got this strong brand name, really developed from its huge first mover advantage, right? It was the creator of cryptocurrency, right? So it got in there early and had all that initial kind of growth and buzz and maintain that going forward. It's readily available, as in it's on many different types of exchanges. You can't avoid it. It's the first thing you're going to see on your screen when they list the cryptocurrencies by trading volume or market cap or whatever it is. There's Bitcoin on the top all the time. Yeah, the future for Bitcoin looks, I would say looks very good, right? There's more and more e-commerce sites and things that are supporting it. Things like Square and PayPal are supporting it. So you're going to see this particularly with Bitcoin as that brand name. It's going to keep getting supported in ways beyond just exchanges, beyond just how we might use it for trading and making money from an investment standpoint. At some point, especially as the coin becomes less volatile up and down, it starts to become more stabilized. You'll start seeing more retailers using it too, whether it's e-commerce or particularly even like online, or that'd be e-commerce, but like brick and mortar type retailers will support as well too. So just like you could pay with a credit card, or you could pay in a fiat currency, you could pay in like Bitcoin. Much more likely to happen with that big first mover, that big brand name Bitcoin, than let's say other coins. And also some more government support around it again too. Established brand name. If they're going to really start approving coins from a government regulatory standpoint in a greater degree, they might approve things and do regulation around the whole universe of cryptocurrency, or they might start segmenting out something, say, we're not going to do anything with the rest of it, but we're going to focus on a couple. If they're only going to focus on a couple and really start getting approvals around that, Bitcoin will be in the mix for that because of that fundamental aspect of that brand name and its huge first mover advantage. If we compare that to the number two right now, which is Ethereum, that's a developing brand name from a fundamental standpoint. We're thinking about this fundamentally, a developing brand name, readily available on all these exchanges as well. It's really on a roll. It's on the sustained rise, and it's different from Bitcoin, right? It differentiates itself with like the smart contracts and things. So you could say like, oh, Bitcoin's great for this, or it's got this great brand name, but I know Ethereum does that, trading, for example, and as a medium of exchange, but also does so much more with smart contracts and people building on the Ethereum network. Again, adding more value to Ether, the coin underneath Ethereum. So if we think about fundamentals, the thing is with cryptocurrency, it doesn't have fundamental investing ratios like, let's say, the stock market does that aids in evaluation. So if you're in a stock market, you're evaluating companies around all these things we talked about from a fundamental standpoint: brand name, first mover advantage, competitive advantage. But then you're also going to look at valuation and things, these ratios. You probably heard of some like price to earnings ratio, or return on equity, or debt ratio, or dividend ratios, all this different type of ratio stuff that's out there. And cryptocurrency doesn't have that, right? They don't have earnings. It's a coin you trade, right? So fundamentally, you can think of currency as a business from some of these projects, underlying themes, but they don't really act that way fundamentally in terms of serving customers. They just kind of, in some ways they are. You could argue certainly with like smart contracts and stuff, in some ways not. But really where cryptocurrency lends itself very, very well to, as the stock market does as well, is technical analysis or charting, where you're looking at supply and demand and establishing value and using all these indicators we're going to learn in the course that are going to really help you as far as understanding when to buy and when to sell in terms of the technical part of cryptocurrency, because it's much more heavily laden around trading action and supply and demand versus more of, let's say, marketing of a business or a business plan of that nature. In fact, another good way to think about comparing fundamentals and technical, no matter what the security you're looking at, is fundamentals can give you an idea of what to buy. Bitcoin, Ethereum, because the big guys, newer ICOs, those some things you might be looking at in terms of what to buy. And technical analysis can help you on when to do that, when to buy and when to sell. So fundamentals is more about evaluating and buying, maybe a little bit about selling later, but technical analysis is all about being very targeted in your purchases and your selling. So you might say, well, I really want to trade Bitcoin because it's readily available, maybe some Ether too, and I just want to concentrate on those two. Now I want to know, when do I buy them and when do I sell them, and how do I get in and out and become profitable? And that's where technical analysis will help you. Versus you could buy stuff, certainly for the long term and hold things for a long term. You could buy Bitcoin and hold it forever. That's perfectly a fine strategy as well too. In the cryptocurrency world, by the way, that's called HODL, H-O-D-L, stands for hold on for dear life, because we know cryptocurrency world has a lot more ups and downs in terms of prices. Another reason why it lends itself well to technical analysis, because they have these wide price ranges up and down. You have more opportunities for trading and buying, low and selling high, which is always the name of the game in any security that you're trading. For a lot of people, what's a kind of a hang-up is like, well, what time frame should I use? How far back should I look when I'm trying to evaluate my charts? And what kind of trader am I? How frequently do I trade? And does the time frame impact that? And that it does. The length of the time that you consider for your technical analysis can change the way you look at things for sure. You can look at things based on minutes, real quick changes, or hours, or days, or weeks, even months or years. And while the concept, the universal language will be the same, how the chart looks and how you interpret it might be different if you're looking at, let's say, hours in a day versus, many days in a month. And there's kind of things where you hear about, there's certain types of traders, like day traders, that have terminology around that, or a swing trader, an active trader, different things. For right now, I don't want you to worry about any of that. You don't have to worry about your time frame. You might already have a feel like, oh, I want to be a day trader. I just want to trade every once in a while. All that's okay. You don't have to pick your time frame right now. In fact, your time frame will kind of pick you as you go through things and you start paper trading and practicing and backtesting. You might find that you actually like or gravitate towards another one as you get through the course. Again, the tools and indicators will apply no matter what the time frame. So, for example, a day trader would constantly buy and sell during the day, right? They're constantly buying and selling. They're doing that. And at the end of the day, the whole idea of day trading is you're going to close out all these positions, or basically things that you bought, and then you're going to sell them at the end of the day. So you don't carry anything forward, no stock or security or anything that you're going to carry forward in the next day. So for a day trader, their time frame, because it's all going to happen a day, they're looking at minutes and hours, right? They're not going to be concerned about, months, because it's not happening in a month. It's happening over this shorter time frame. Again, no right or wrong answer, just that if you want to do that, you're going to adjust your time frame. And at the end of the course, we'll talk about this in more detail as we now apply those concepts as far as trading. So a day trader might think, oh, it's my job. I look at minutes and hours. An active trader might say, oh, I love it. And they might look at days and weeks and months. They don't trade as much. And certainly a buy and hold investor might look at, when they maybe get into a security, but they don't really trade much, getting in and out. They get in more, but they get out sometimes. So it'd be looking at more weeks or months, maybe even years as time goes by. So picking a time frame, once again, you do not need to decide now. That's very important. Don't worry about that. Concepts work the same, no matter the length of time. And however long the time, one thing to take away is the more established the trend is. A trend that's been going on or a certain direction, for months is going to be a very strong trend versus something that's going for minutes or hours that might change quickly. And thus you're getting in and out of positions quicker if you're a day trader than, let's say, if you're more just every once in a while trader. Both are perfectly fine. Even though we're trading individual securities, it's good to always be aware of what is the general broader market sentiment. What is generally happening in the markets? Are they moving up? Are they moving down? Are they sideways? What's going on in the bigger market? Because the individual securities will tend, not exclusively, but will tend to follow the overall market trends. They not necessarily will go up higher or down lower. Those things happen or don't happen, but they'll tend to follow along. Think of it like a rising tide lifts all boats, and the same thing when the tide falls, all the boats go down, right? So it's a similar thing with prices and securities. And there can be headwinds and tailwinds that you're fighting against too, maybe with an individual security that's either helping it, a tailwind, or hurting it, like a headwind. Sentiment indicators, and we have some coming up later in the course, like Bollinger Bands and other ones, can help strengthen your decision making as far as what you want to do. And if, in general, if the individual security is going, let's say, with the market sentiment, that's a good thing that helps you. But if it's going against the market sentiment, that would be something to be aware of as well. Doesn't mean you can't. That's part of contrarian investing and all that too. In fact, that's where sometimes the best opportunities lie, is going against it. But just understand that you have this broader market sentiment out there. One thing that is very impactful and really to look at closely whenever you're looking at individual securities to trade and be aware of is volume. How much, are there a lot of people trading something, or is it really kind of low volume in a particular time? And you're looking at that volume over a period of time. And a high volume can help confirm a price move. They'll kind of go together where whether up or down, there's a lot of trading that's driving that action. And sometimes the volume can lead the price where something is coming. There's a lot of people trading because they think something's coming. It's been an announcement of some sort, or there's just something going on that's, an indicator showing something, so people are getting in or getting out. And so volume can help precede that sometimes. Sometimes it trails, but a lot of times it may precede it. And certainly when the event happens, that's where you might see a spike in volume too. One thing for technical analysis traders, we're really concerned about breakouts and retracements and understanding the difference between the two. And so if we look at that in this lesson, normally you have a trading range or a price range where you have a low price range or low price and you have a high price, and the security will trade within that range over a period of time. And again, that period of time could be hours, days, months, whatever that period of time. But price will tend to stay in that range. And you might have some general trends within that range where it might be flat or kind of going sideways, or you might have a general uptrend, or you might have a general, let's say, downtrend kind of within that range as stocks or securities constantly changed, throughout that time frame. But then things can happen, where it can break those general trends and start, reversing or going into a different trend. And is it truly happening, or is it more kind of like a fake and it's not really happening? And that's very important for us as technical traders to know when to help us when to buy and when to sell. So if we think about that and conceptually, trends will continue until the pattern breaks, right? So something's got to break the pattern. And a lot of times what happens with breaking the pattern is something happens. There's some type of thing in the news, for example, it's something on a global scale, whatever it might be, or even just a rumor might, break the pattern. And that's what might be a breakout, right? It's going to break the pattern. Or it might be a retracement where it's really not a true breakout. And that's the idea, is something happens, there's some news or a rumor, and then something's going to happen, right? So traders are either going to do nothing, but they might, let's say, start to really panic based on that news and sell real quickly and really panic. So, oh my gosh, this is terrible news. I got to get out fast. And so they kind of selling maybe quickly. The same thing if the news is great and there's some great announcements, they might have that fear of missing out, right? FOMO, right? They're like, wow, this is really taking off. I always thought it was really good security, but now it's really going. I got to get in fast and buy, right? So you have sellers and you have buyers, right? So that disruption is actually called a breakout, right? So that means something has changed and you've broken out of the new pattern. And there's either going to be a new uptrend, going up, or there's maybe going to be a new downtrend. And you might also have like a false breakout where it breaks out, but it's not really due to supply and demand or market sentiment or anything. There's something that's, causing a short-term disruption into it. And that could be something like which relate to like position squaring by big players, right? Real big holders of things that might be adjusting their holdings in a particular security that's causing some disruption in the market versus some more legitimate news. When you see movement and you see something like there's a big announcement that might be related to it, you want to say, okay, is this really happening? Or is this just going to be a short-term type thing and it's going to come back and pull back? In fact, we call that pullback retracements. And that's the breakout is where it breaks out and now is forming a new type of trend. Retracement is where it breaks out a little bit, but it's a minor move that's going against the trend and then it's going to come back, like the big player repositioning. So if traders think a current move has gone too far, they might have a little course correction or a little pullback, but then the trend might come back up again. As we learn through the indicators, we're going to learn how to spot breakouts and retracements and how to kind of use confirming things to see whether we're seeing a breakout or a retracement. Is it a true move or is it kind of a temporary type of false move? And sometimes you might see retracements, for example, where everyone has either bought or sold, right? There's an overbought situation where, everybody wanted to buy is already bought, so it's extended, so it's kind of have a natural kind of come back. Same thing if something's oversold. And then we have these tools that can help us with that. One is the stochastic oscillator, which is a fun thing to say. and also will help us to identify things. And there's other tools and things we're going to be learning about that'll do us too. And a lot of times, another good way to look at it too, just early on, if you see volume rising, that bottom part of the chart, and you see volume rising where there's a lot of trading activity, but there's hardly any price movement, hardly any price increase, then the move is, whichever is happening, is probably ending. It's starting to stall out. So we think something's been rising, uptrend, for example, it's been going great, but now there's hardly anybody doing it now. It's really starting to slow down, stall out. Might be a time either for a temporary pullback or retracement, or maybe we might even have a breakout in the opposite direction, or it might go, backwards. So retracements, they can turn out to be actual trend reversals. I mean, it could be, looks like a retracement, but really it actually is a breakout and you have a new trend, or it might be truly an actual retracement where it's just temporary and then it'll kind of go back to the way it was trending again too. All this very normal. And with the technical analysis that we're going to be using and using our indicators, we're going to be able to handle and deal with both breakouts and retracements and identify great opportunities to purchase and also identify times when we might need to sell and get out as well. It works both ways. All right, so we've got some foundational concepts here, but now let's get into some really the detailed stuff, and that's the indicators. This is the tools, the things we're going to actually use to help us, make decisions around securities to buy or sell, for example. And indicators are really at the heart of technical analysis, and it's really our technical tools we're going to use to help us be successful. And indicators are all based on things like math and data and trends and all that. It's very focused on trends, of course. You want to anticipate trends and then make your decisions based on where things are headed or where the trend is headed. And technical analysis and using indicators is also all about eliminating emotion. You're not tied into, oh, I love that stock, or I love that last movie from Disney, so I'm going to buy Disney stock, or whatever. I heard a great thing about Bitcoin, or whatever it might be. It takes emotion out of it, and you're really looking at these indicators from a real unemotional way. What is the indicator telling me versus my likes or dislikes about something? And that makes them very, very good to use in that manner, very way that takes emotion out. Now, they're not perfect, because nothing's perfect. If there was, I would have one lesson, and it would be about what's the perfect indicator to use, and that would be it. But they have different applications and different ways you can use them, and some work better than others, or in certain situations, or with certain types of securities. And we'll go through that as we go through the course. But just be understanding that nothing, of course, is perfect. In fact, really beware of anybody who says, I've got the perfect system or the perfect set of indicators or things of that nature. They don't. They might be able to share some good stuff and might be helpful, but just beware of anybody who's trying to sell you something for money that is the perfect answer. That's probably or it is fraudulent, because there hasn't been a perfect indicator out there yet. So indicators at their heart, what they do is they're technical tools that help distinguish between noise and an actual event. Okay, so what is that? So an actual event is something that's real, something that's happened either with a company or an organization or a currency or globally, whatever it might be. Something's happened in a broader sense or specific to that security. And it's a real live event that's going to make a change that's going to happen with trends, whether they're going up or down or sideways. Something is a real change. Versus noise, noise is things that are not dramatic and it does not change the overall trend. It might cause it to blip up and down a little bit, but it's not going to actually dramatically change the event or change the trend, where an event definitely is dramatic and changes the trend. Or it might strengthen the trend to have it continue in a strong manner, whichever way it is. But it's not a temporary thing like noise might cause. It's a real thing. So that's the difference between noise and events. And indicators help us to separate that out so we can kind of tell what's true and what's false and what might be, really the core things that we want to focus on as far as making our buying and selling decisions using indicators when events happen.